Alright, yeah, welcome back to my channel. And like we always say, don't forget to subscribe to our channel, like our videos, and turn on the notification bar for more live updates. And you can also refer us to other students that are in need of accounting knowledge, that are finding it difficult to do their accounting calculation or postings into various accounts. Now, we try to make it as simple and as easy and as applicable for everyone in order for them to understand these various postings. So today we are going back to the root of accounting, because we notice that a lot of persons find it difficult in order for them to post or to answer accounting questions because they lack understanding of the basic principles of accounting. And one of the basic principles of accounting is that, which is what we are looking at, is the principle of double entry. Principle of double entry means that for every credit transaction, there must be a corresponding debit transaction. Now, mind you, in our posting, remember in accounting, we have what we call the debit side and we have what we call the credit side. So for every transactions that we enter in, every transactions in a business must have what we call the debit side and must also have what we call the credit side. Now, in most cases, we say the debit side is used for entering, posting every expenses that goes on within a business, and then the credit side is used for recording or posting every income within an organization. But in terms of the cash book, the principle is switched, because every income goes to the debit side, is recorded in the debit side of the cash book, and every expenses is recorded in the credit side of the cash book. So cash book accounts for expenses or expenditure in the credit side and income or revenue generated in the debit side. But in singular account or singular posting, where we say we want to enter rent account, the income goes to the credit side and the expenses goes to the debit side. Now, we also said that in terms of entry, double entry, we should understand that every sales, every transaction comes in two forms. We have what we call the cash transactions and we have what we call the credit transaction. Now, you can't go into business trying to eliminate entirely credit transaction. You can't entirely eliminate credit transaction, because the aim of every business is to do what? Is to maximize profit. And you cannot maximize or make profit when your goods are still stuck in your warehouse or your store. So you try to make sales and try to make turnover as much as possible in order for you to increase profit. And then when you know that a customer is credit worthy, and once a customer is credit worthy, meaning that the customer have the ability to pay for goods that are given to them in due time. Now, such customers can be, goods can be sold to such customers, or services can be rendered to such customers with deferred payment, meaning that they get to pay within a given period of time. Now, in such cases, then we say cash transaction. Cash transaction is a process in which cash is paid as soon as goods leave the hands of the supplier to the receiver. So once we sell goods and then the goods are being, before exchange of goods on services takes place, there must be cash payment, there must be cash settlement. So once cash is paid, then ownership is transferred from the owner to the recipient of that particular good. Now, that is termed cash transaction. So there is nothing like deferred payment in terms of cash transaction. And once we have cash transaction, the only thing we need to look at is what? We look at cash account, then we look at our ledger account. We look at our cash account and we look at our ledger account. Then also, if you are going into the credit transactions, now there are certain particulars, there are certain books that are used to record credit sales or credit purchases within an organization. We have what we call the day books. Now, under our day books, we have the sales day book, we have the purchase day book, we have return inward book, we have the return outwards book. Now, in terms of returns, Our sales returns. Sales returns has to do, as the name implies, says any transactions in an organization where you sell goods, there's exchange of goods for credit for deferred payment. Now, meaning that you are the one selling the goods, you record it under the sales day book. Purchase day book, when you obtain goods from your suppliers, creditors. Now, this is also debtors, this is also creditors books. So when you obtain goods from your suppliers and under deferred payment that you are paying not immediately but over a given period of time, you record it under your purchase day book. Then return inwards or sales return. You know, sometimes you can sell goods and maybe the goods will be returned because either it did not meet with the quality, the standard, the specification of the buyer, or the size does not fit as specified under the description, or the goods have expired so they cannot be consumed, or the good is spoiled. Now what do? They return that goods back to you. Once they return it back to you and refund is made, it is recorded under the return inwards. Then return outward has to do with you returning the goods that you bought back to your supplier for various reasons. So under credit transactions is recorded one where under our day book, and after our day book we also look at our ledger account or our ledger posting. Now let's look at some examples that we have on the board and try to look at the effect of each transaction. After looking at the effect of each transaction, we will also do what? Look at the action step and then carry out the posting on this sales account. Now let's take it step by step. The first one we say January 1. Now, okay, let me read it first. January 1 started business with 40,000 naira. Now, if you can remember, go back to your early years in business studies. They say factors of production. We say we have 4 major factors of production, which is land, capital, we have labor, and we have entrepreneur. Then under the capital, which is what I want to make emphasis on, under the capital, we say capital are wealth that are set aside for further production of more wealth, or money set aside for the production of more wealth. Money introduced into a business for production or facilitating production in order to create more wealth. Now, when you are starting business, that is the money you set aside, the money you introduce, the money you put into that business in order for you to make more profits is called what? Capital. So January 1st started business with 40,000 naira. That is what? We have 2 transactions there. There is a cash involvement and then there is a capital that was introduced into the business. So let's take this. January 1st started business with 40,000 naira. Now let's look at it. Let's split it into the 2 forms of accounts that we have. Remember, we said there is a every debit transaction has a corresponding credit transaction, meaning that every transaction you can have what? 2 classes of account, and this is cash account, meaning that there is money involved. So we have what we call the ledger account and we have what we call the cash account. Now let's look out for it. This started business, as I said, is what? Capital. And the money that was introduced is what? Cash. Now, what is the effect of this transaction? We have 2 effects. Number 1, there is increase in what? In capital. Now, our capital has increased, which is under what? Capital account. Then number 2, what other effects do we have? We say increase, because when you introduce the money in your cash will do what? Will go up. Your revenue has increased. So we say increase in assets. Now under our assets, which account are we opening? Cash account. Now what do we do? What are the action steps that we need to take when opening the 2 various accounts, which is capital account and cash account? Now, looking at this transaction, another thing we need to understand is who is the giver and who is the receiver. Now, if you say started business with, capital is the one that is giving the what? The money out. And who is receiving the money? Cash account is the one receiving the money. So what do we do? Since this is giving, now what do? We say we credit capital account, which is what? The giver, and we do what? Debit our what? Cash account, which is what? The receiver. Now, how does this apply? In order for we to know what to do, how do we apply it in terms of posting into the double entry or the ledger account? Now, see what I'm going to do. The first one, this is my capital account. I have capital account, rule my line. This is my debit side, this is our credit side, isn't it? So, yeah, it said under the capital account, what do? We credit it. So, I'll put my date, January 1. Now, what was given from the capital? Cash was given, so I'll record it as cash. How much of the cash was given? We have 40,000 naira. So, yeah, I'll just close because that is the only amount, which is 40,000 naira. Then here I'll be balance brought down. Balance brought down from here is what? 40,000. We cannot leave this side of the account open. We have to close it properly. So this is 40,000 naira. This is how it will come out in terms of our ledger account. Then let's go to the cash account. Having seen our illustration here in terms of our posting, we have our ruling. This is our debit side. This is our credit side. Now, in terms of the receiving, we say we should do what to the cash account? We should debit it because it is an income. I remember I said income in the cash book is recorded on the debit side and expenses is entered or recorded on the credit side. So I have my date, January 1st. What was received as cash? Like in terms of the transaction, you need to put, or in order for them to understand, the money that came in terms of cash was for what purpose? It was a capital, money that was invested. So I have capital, which is 40,000 naira, right? Good. So what do? You close this account. Now, when you close it, you have 40,000. And what do here? You have your balance brought down. Your balance brought down is what? 40,000. And we close 40,000. Do we understand this concept? That is just that for that. Now, you see that in terms of the effect, we've seen how it increases in capital, increase in assets, and also the action step, you have to credit your capital account because money is coming in. You are having more money in your assets, and then your cash account, more money is coming in, you have to debit it, exchanging the particulars for each of the accounts. Then, if you go to the second one, we have January 2nd. It said paid 450 naira cash for rent. Now, looking at this, anytime you see paid, purchase, just know that it's an expenses, meaning that money is leaving the organization, right? Good. Now, it said paid 450 naira cash for rent. There are two things that were involved. One, what was leaving? We have cash, and then we have rent. Now, these are the two ledger that we are posting. Now, what are the effects? Under the cash, what is happening in the cash? It is reducing, right? So we have decrease in assets. So our assets decrease under what? Cash account. Now, what also this is expenditures, right? Rent is an expenditure, it's an expenses incurred in a business. And what does it do? So when you pay for your rent, it also increases your expenditure. So here you can say increase in expenditure. Now, increase in expenditure under what account? Rent account. Now, how do we enter this? What is our action step? Action step to take. What do? Under our cash account, since it is reducing, you have to credit cash account because it is the what? Given. The money is leaving a cash account. Then debit rent account because it's an expense, so we have to debit it under the rent. So Rent account is the what? Receiver. Is the one that received the money. Now, how do we make this posting? So, in order for me to post it into the ledgers now, I'll start with my cash account. I have, what are we doing? Credit cash account. So, I have my date, January 2nd. So, what transaction reduced the cash? What transaction did we pay for? We paid for rent. So, I have rent. Rent is how much? We have 450 naira. So we close 450. Then here we have balance brought down. Balance brought down is 450, which is what? For rent. So we close 450. Then the second account we are opening is the rent account. Now, under our rent account, we open our posting is credit, this debit. Now, because it is an expenditure, every form of expenditure in the individual account is recorded on the debit side, and every income is recorded on the credit side. Now, knowing that, here we said debit rent account, which is the receiver. So I have January, what? 2nd. And in what form did we pay? Is it check or cash? Cash. So I have cash. And this is 450. Then we close 450. Then my balance brought down is 450. Then 450. Now, do we have understanding of this? We've seen the effect, we've seen the action step or the action required, then we've seen the posting, how it goes into the account. Now, I will want to clean, if it's okay with you guys, so that we can proceed into January 3rd, 4th, 5th, and 6th. I believe we have understanding of this now. So, in January 3rd, the sector received refund of insurance. $300. So we received two things. The first one, we have insurance and we have cash, isn't it? So what is the effect of this transaction? Now remember, if you pay for insurance, you know insurance is transfer of risks from the insured to the insurer. And at the end, at the event, one of the principles of insurance is principle of indemnity, meaning that at the event of a loss, the insured must be restored to the point where they were before the loss took place. So, take for example, I insured my pen for 300 naira, right? 300 naira, great. And I lost this pen. So the insurance company have to bring me back to the position I was before the loss. So I was paid 300 naira cash back in terms of the insurance. So that is what this means. Now, receive in refund of insurance. What is the effect? Under the insurance account, what happened? We said reduce expenses, which is insurance account, or we can say income. We can say income also. Then here we can say under the cash account, we say increase in asset. Now increase in asset, which is our cash account, right? So what are our actions there? The first one, insurance. So what do? Because the insurance is the one giving out. So what do? We credit the insurance account. Which is what? Is the giver. And we debit cash account, which is the what? Receiver. okay, for a better expenses, for a better understanding, you can just say increase in assets, okay? So that when we are posting, we'll just have understanding of it better. So here you can say increase in assets, because it also increase, which is also the same thing, reduction in expenses, meaning you are not paying for that insurance, you're also receiving. So how do we post this now? Under the insurance account, because insurance is paying us, we are not paying them. We are not giving premium. Instead, we are getting indemnity. So it goes under the credit side. So we have January 3rd. What is being paid? Cash. Cash is paid back and is 300 naira. So we close. Let's put your sign. 300. Then I have my balance brought down. 300. Then the second one, cash account. Debit and credit. Now, because cash is receiving, so it comes to the debit side, which is January 3rd. And what is paying is insurance. That is the title of that transaction. 300. So we close 300. Then balance brought down. We have 300. And then we close 300. Now, you see that this principle, in all of this that we've been doing, the principle of double entry is being applied. For every credit transaction, there is a corresponding debit transaction. So you cannot have credit transaction, you cannot have debit transaction. In the two different classes of account and posting, one must go to the credit side and one must go to the debit side, which is the principle. So once you understand this principle, it makes it easy for you in posting in any form of the account. Say we have January 4th. Now this looks a little bit technical, but very easy. The proprietor puts a folder, how much? 500 into the bank. Now, when the proprietor puts a further amount, now what does that entail? Think. Alright, let me see. From what you guessed, I don't know what you guessed, but the actual answer is capital. Now, because it's introducing more money into the business, the proprietor is the owner of a school. So he's introducing more money into the business account in order for them to use the money to produce or to make more wealth. So that becomes what? Our capital. Meaning that we are having increase in our capital. And also our assets, which is the bank, is also increasing. So what are the effects? We have double increase. Increase in capital. And that will be under what? Capital account. And also increase in assets. And this asset was not given by cash, it was paid by bank. So it will be bank account. Same principle with cash. What are our action step or action required? Now we have, because capital is coming, we'll credit capital account. And capital account is the what? Giver or receiver? Guess. I know you guessed that right. If you guess that right, that will be the what? Is the giver. Because the proprietor giving the money, the bank is the one receiving the money. So we say debit bank account. And the bank account is the what? Receiver. Do we understand? Now, try to open your accounts. The first one, capital account. What do we do? These are debit and these are credit. Under our capital, they say we should credit capital account. So I have my date, January 4, capital, and what was given, it was paid into the bank. So bank, and how much? It was 500. So I close 500. Then balance brought down, it's 500. Then I'll close 500. Then I'll open my bank account. Then under the bank account, we have a debit, we have a credit. Okay, now what did he say? He said what? We should debit our bank account. So January 4th, what did we receive? Capital. And how much is our capital? It's 500. So close. This will give me 500. Then here is my balance brought down, 500, close, 500. Now, do you understand these concepts now? We have 2 more to go. If you don't understand, just follow us diligently. And I know that before the end of the class, you are going to have full understanding of it. Then, I also advise, maybe after the videos, you take a pen, you take a paper, and write out the question and follow the simple step. Just follow the simple step and see your posting, okay? And see if you're able to get it. If you're not able to get it, don't give up. You know, we also make mistakes and we learn every day. So we shouldn't give up because we make mistakes. Just be persistent. Watch the video again, and as you watch the video again, you see you have better knowledge next time. Now, this is the last 2. January 5 or 5th, but remember I said but is an expense, right? Motor vehicle, 800 by check. Now, 2 things. The giver is a bank and the receiver is a motor vehicle. What happened? We have increase in asset. Motor vehicle in terms of balance sheet is an asset because it is something in an organization that can easily be converted to cash, that can be liquidated and converted to cash. So it is an asset, meaning our asset is increasing, and then our asset in terms of our bank is what is reducing. So that is the effect. You say increase in asset, which is motor vehicle account, then decrease in assets. Remember, when you pay by check, it's not cash that the person is receiving. It is check is standing order to a bank to make payment to the bearer of the note. So it is the money in the bank that reducing. So it's not cash account, rather bank account. So what are our action steps that is required of us? Now, the action step that is required of us is what? First, because this is an expenses, we'll debit motor vehicle account, and motor vehicle account is the receiver, and then credit bank account, and bank account is the what? Giver, right? So in terms of our posting, how do we post this? We have motor vehicle account, debit. So here I have January, my date, and what was paid. We received check. How much? To the tune of 800. So we close 800. Then balance brought down 800. 800. So that is that from a motor vehicle account. Then the next one is bank account. Cash book principle. Remember that every expenses goes into the credit side and every income goes into the debit side. So because money is leaving our hands, we record it in the credit side. And what are we paying for? Motor vehicle. And how much? We have 800. So I will close 800 and balance brought down, it's 800. Then I will close also 800. Now, the last transaction that we have, January 6th, cash sales. cash sales is 8,000 naira. Now, under this, we have two transactions that took place. Cash was received, goods were sold. Cash was received, goods were sold. So what is the effect? Effect is 1. Increase in assets. Under the asset is cash account because we received more money. Then increase in sales, meaning more goods left are stored under sales account. And what is our action step? Now, once you make money from sales, it means that the value, the assets that you have in your organization increases. So we'll say that was effect. We'll debit cash account, and cash account is what? Receiver. And then we'll credit sales account. Sales account is the what? Is the giver. Alright, I hope you can see that clearly. So let's start our posting. Cash account. I have debit and I have credit. We are debiting because we are receiving. So we have January 6th. And what happened? The transaction that occurred is sales, and we received 8,000 naira from the sales. So the value of what we have in the organization increased by 8,000. Then our balance brought down is 8,000. So I will close 8,000, right? Good. Now, under the sales account, I believe you know your posting already if you look at it. Then here we say sales account. Debit, credit, goes to the credit side. So I have January 6th, and what happened? What did we receive? Cash under the sales to the tune of 8,000 naira. So I will close 8,000 naira, and my balance brought down is 8,000 naira, and then I'll close. I guess this is interesting, and it's actually very simple once we understand the posting and we understand the process, the principles to apply. And once we know this principle already, you can apply it into every transaction that was given to you to post into the double entry. So this brings us to the end of our class for today. Like I said, you can always help our channel. How do you help to promote our channel? You can help by liking our videos, subscribing to our channel, turn on the notification bell for more live updates, and also try as much as you can to recommend our videos to those that are in need of this knowledge. This knowledge will help them to have basic accounting principles that will help them in recording any transactions or posting any transaction that has to do with accounting. So for now, just do the necessary, and we'll see you in our next class. Thank you for watching our videos.